Well, that was such a great setup by my colleague in Bloomberg Intelligence. We don't need to speak anymore. No, it was fantastic. I actually do want to say, before we kick off our panel, the segue was perfect from the prior speaker, because he was just saying that if we're polite to these LLM models, it consumes more energy and becomes a lot more expensive. So we've got a poll that should be coming up in a second. Do you say thank you to your AI model? Yes? No? I haven't used an AI model yet. So scan the code. And while you do that, I'm going to get started with the panel. It's really good to be talking to you. Navid, I'm going to start with you. Maybe just set the stage for us, because, of course, there's so much hype around artificial intelligence, and the two things sort of go hand in hand. You need the data centers to train a lot of these models. How do you see AI impacting data center infrastructure in the coming years?
Yeah, no, good question. But I think if you take a step back, you have to look at the whole demand for cloud storage to start with, and then how AI is having an impact on further increasing it. Just while we were waiting backstage, I was just looking at the history of cloud. In 2004, the word cloud storage did not exist. Smartphone maximum memory was 5 gigabytes, now it's 100 gigabytes. And just the amount of data storage created by the smartphones that we all have now is 246 billion gigabytes. Add to that Netflix, Amazon, Spotify, Teams, WhatsApp, Zoom, and you are, and the fintech demand, and you are at 3 trillion gigabytes. Add to that artificial intelligence now, the language learning models that you mentioned, and that's supposed to be 50% of cloud storage demand in the next few years. So from our perspective, AI is, yes, enhancing the demand side, but as QIA, we've been investing in data centers for the last 10 years. What we are focused is not so much on the demand side, we are focused more on the capacity side, the supply side, that do we have the capability and do we have the right partners to deliver these data centers that are required, both for hyperscale cloud storage and also for AI. And there are various challenges around that.
I'm going to come back to that point. Doug, I'd like to move on to you. You recently announced an expansion of your global data centers division, land across pretty much everywhere, from what I can tell, North America, Europe, Asia. So it sounds like you see very strong demand as well, but not specific to any region, everywhere.
Yeah, so we look at everything from a global perspective, and we believe that there's going to be growth all across the globe. Right now, we're seeing strong demand signals for the last couple of years in the US. Europe's been constrained because of power availability. Some of the same issues exist within Asia. And so we have a team of people that have literally scoured the earth to find 10 plus properties, a little over 2 gigawatts of building load capable in those properties to build out. Because what we're seeing as a company is our pipeline has swelled over 25% year over year. We are seeing tremendous offtake from both enterprise and cloud, as well as AI. And if you look at the stats on AI and the projected growth rates, Jensen Huang talks about his belief that AI, will contribute to over it'll be necessary to contribute over $1 trillion worth of data centers over the next 4 years just to meet the AI demand. And to put that in perspective, it's taken 15 years in the cloud environment to hit that $1 trillion data center number. So it's about 4x what you're looking at for AI. So we're extremely bullish on the global platform, and we're seeing different areas of the globe that we're investing in for different reasons. In the US, India, it's mostly hyperscale, and that's where we're seeing most of our absorption, most of our offtake. Within Europe, there's a fair amount of retail and enterprise, and within Asia, we're seeing a tremendous amount of enterprise, and we're starting to see some very large takedowns for AI and cloud. And so the properties we've purchased over the last year have been Milan, Frankfurt, Hillsboro, Oregon, several in Tokyo. We've purchased all across, so we're starting production on those. And frankly, on about half of those properties, before we even put a shovel in the ground, we've already lease the properties out either partially or completely. So we're extremely bullish on the outlook of the industry. If you just go back a year ago, 2 years ago, the CAGR was 13.5%. The projected CAGR now is 23%. So, there's not a lot of industries growing at that rate, and we're very bullish.
Yeah. The numbers are huge, though. $1 trillion is a chart up there. $230 billion, some of the big spenders last year, those 5 that are listed. Marc, let me ask you, there is a lot of money going into this space. There's skeptics out there. They're nervous about there potentially being a capital glut and for all of this to come crashing down. Are we setting up for another bubble? Is this going to be another dot-com bubble in the space?
Yeah, look, to contextualize it, I think that we're in a very different environment from a demand perspective. I think you saw a lot of speculation in the dot-com era where people laid fiber cabling with no customers on the other end of those cables. I think what's interesting, having been in the sector for 30 years and having watched some of these cycles, what is different about this cycle is we don't have a demand problem. We have plenty of customers that require compute. We certainly don't have a lack of land, and we certainly don't have a lack of capital. What we do have is a lack of power. We can certainly drill down into that. But on the capital side, it's actually interesting. I think most of the allocators globally, and Navid, you could vouch for this, I think investors have put a lot of capital to work in data centers, particularly in infrastructure funds. And a lot of these platforms that they've developed have reached a level of $10, $15, $20 billion. And ultimately, LPs are saying the same thing, which is, okay, this has been great. We've enjoyed riding this AI wave, but at some point we need capital back. How do we create DPI? And how do you recycle capital? Investors obviously want to invest in great ideas in AI. They want to be exposed to investment-grade leases. But at the end of the day, we do have an obligation as a GP to return capital and to create returns. So one of the things that I hear most recently in the last sort of 6 months of fundraising is, what are you doing for us in terms of returning capital? By the way, it was the same thing that happened in cell towers in the late 90s. It happened in fiber in the early 2000s. It happened, Doug, with cloud computing in the last 10 to 15 years. People want that capital back. And I think ultimately it's about where you sit in the capital structure. And if you think about the progression of how digital infrastructure has been built, it started almost as venture capital. It migrated to private equity. And then ultimately it now sits with infrastructure funds. And now there's the next leg that's going to play out, which is 90 to 120 billion of stabilized data centers that ultimately has to be in real estate vehicles, whether it's a publicly traded S-REIT, or if it's a continuation fund, or if it's really insurance capital that's coming into the sector for the first time. There is going to be a recycling of capital that is going to happen. And we're in that moment right now. Would you say there is a funding gap, though, given the needs and given your projections? I don't think there's a funding gap. I mean, we put out about 26 billion of CapEx last year just at DigitalBridge alone. We have another 19 billion that's funded this year. And I think the way that we're funding those assets today are perhaps a little bit different from how we funded it 3 years ago. I think certainly the financing market has matured. We're talking about equity. We haven't even begun to talk about debt. I think the way these assets are now being deployed in the securitization market and the depth of that securitization market, particularly through investment grade, is about as deep as you've ever seen it. Just in the last 30 days alone, we had 6 data center securitizations that got launched and closed across many different platforms, across many different GPs. If you aggregate all of that securitized capital, which is predominantly insurance companies or opportunistic debt investors, there was close to almost $12 billion of securitized paper that's traded hands in digital infrastructure in the last 30 days. So there's a coming of age of this asset class that I think is really interesting. I've gotten to watch it because I started in the early 90s when I was backed by family offices and venture capital. And now today we're an infrastructure fund. But I think this progression of capital is really important. And I think the movement of capital and the maturation of the debt markets for digital infrastructure is something that's really important. So we don't have a funding gap as long as capital keeps moving. Capital has to keep moving in this market.
Yeah. Goodwin, one of the big events earlier this year was DeepSeek. And for those in the space, it wasn't a massive surprise. But for the rest of us who are sort of tourists in the worlds of LLM, it did come as a surprise that China were becoming competitive in foundational LLMs. How does that change the picture for China, and for the broader Asia-Pacific region to have China really powering ahead with their own foundational models?
And I think historically we've always seen China is actually very good at taking what's new technology and then adopting it, adapting it to create a actually better user experience quite often. In this particular case, I think there's a lot of excitement in particular whether it's the West, APAC, or China about inference. Right? So when you go back to the supply-demand question, you also have to ask yourself, because data center, you have the old architecture are done, first is co-location, secondly is cloud, and then thirdly, the new big use for AI is training, which actually the Blackwell chips are what, 132 kilowatts, right, demand, going to 600 kilowatts of Rudin, but cloud architecture is only 10 kilowatts, right, less than 10 kilowatts. So you look at that, and then you have to ask yourself, where's the supply-demand imbalance? Is it too much supply potentially on the hyperscale training side? Right, in China, the word is east side is for data, west side is for compute. Because east side is where it's cooler, much cheaper power. Right? For example, China doesn't have a power constraint issue. 2% of the power today is consumed by data center, going to 4% by 2030, going to 2030. By 2035, it's expected to be 10% of the total power. And it has a much more modern power grid. When you take all that into the equation, then you realize in China, you're seeing a little bit of how the world actually could play out. Because China is one big country, you have the training being done on the east, you have compute being done on the west, where it's closer to population. So latency matters, inference is actually where it's driving the demand right now. So the supply-demand imbalance could very well go back to which part is the supply-demand imbalance. Very well, we could actually be completely undersupply on the cloud architecture side, right, where it drives application, it drives inference.
Where do you see growth, where do you see the fastest growth in the Asia-Pacific region right now?
Certainly China is playing catch up. Where China this year, they're talking about $50 billion plus of CapEx spending. So China actually went through a very high CapEx spending during COVID because of stay at home, e-commerce adoption, and so on and so forth. And then went through a lull because of the chip war with US. So lack of ability to get chips. And also the big players couldn't quite figure out, is it going to be a winner takes all on LLM? So not all the biggest companies were focused on creating or chasing LLM because the business model is less clear on the LLM. Right? So you have a bit of a lull, and DeepSeek actually seemed to have all of a sudden create urgency for everyone to play catch up. So the $50-odd billion in capex in 2025, it's a 59% year-on-year increase from last year. And then three major players, Alibaba, Tencent, and ByteDance alone, each spending over $10 billion. Actually, 100 billion RMB, so 14 billion per company. And then there are another three that are Baidu, Meituan, and Kuaishou are actually over 10 billion RMB in spending alone in 2025.
Wow, the numbers are big.
So it's a big catch-up.
Okay, let's bring up the results of the poll that I asked in the beginning. If anyone is a polite user of AI. Most of you are polite. Okay, so about 2/3 of the room say thank you to the AI model. So this question is relevant because AI is notorious for consuming a lot of power. Navid, I want to come back to you. You touched on this in the beginning, and you were saying, one of the considerations is the sheer power consumption that goes into powering these data centers. Is that the only consideration?
That's certainly one of the main ones that Marc mentioned. The other one is just in terms of the supply chain dynamics with regards to fitting out a data center has changed dramatically. We are looking at a data center right now which is trying to do an LNG-powered behind-the-meter supply for an hyperscale cloud center, and they went to buy a gas turbine. Only 3 companies in the world that make the gas turbine needed for data centers, Siemens, GE, Innova, and the waiting list is 4 years. So even if they do get the power supply and the land bank suggested, they have to wait for 4 years before they can kick it off. In another transaction, we are involved in the power generators coming from Caterpillar. There's a 9-month waiting list for that.
Right.
There is also another constraint, which is human capital required to deliver these data centers at the right specifications. There are a lot of new players that have entered the space were traditionally real estate players and are trying to do data centers now. I mean, we're lucky to be partners with people like DigitalBridge and Gaw Capital who have experience in this. But finding the right capital, human capital to deliver it is a challenge also.
Yeah. I'd like to ask you about the heat that is generated by powering these data centers as well, because from what I understand, you also need to have effective cooling systems in place. Is that acting as a constraint over how quickly you can build up capacity?
It's a huge constraint, because if you think about the conversations in data centers, they often lead to power, which is our #1 constraint as an industry. To be able to find powered land is extraordinarily difficult. And when you look at AI data centers versus standard data centers, from my perspective, there's really 3 main areas where they differ. First is on scale, because an AI data center generally is much larger. Put that in perspective. The data centers that we've built for the last 10 years have been around 36 megawatt buildings. The new ones we're building are 100 megawatt, which sit on gigawatt campuses. Put that in perspective. A 100 megawatt building powers 100,000 homes. So you're using an extraordinary amount of power. So the first issue is scale around is power scale and getting that power available. The second issue is being able to have the capital to scale, which Marc talked about earlier. And then the third issue is around innovation. And that innovation is all around liquid to the chip, or what's called DLC, direct liquid to the chip cooling, which basically, instead of using the technology we've used for 25 years for data centers, which is air-cooled to remove the heat, because power equates to heat, and you have to remove that heat, we use direct liquid to the chip, which is glycol device attached to the GPU, and it removes that heat. That's the technology that allows AI data centers. If this were a data center hall and a standard data center, you'd have 10 racks of AI sitting in the middle of it and all blank space. In today's modern data centers that we're building, the entire floor would be filled with racks. And so that is really the gating issue that we've looked at for the last 3 years. The claim to fame for GDC is that we're the 3rd largest global data center provider, not including the roll-ups, excuse me, Marc, but standalone data centers, we're the 3rd largest. We've got about $3 billion in revenue, 3,700 employees, 150 countries, 150 data centers in 21 countries. And our claim to fame is that we have 250 megawatts of production liquid to the chip cooling running in our data centers, which outside of the hyperscalers is the greatest amount. And I can tell you, it's been an incredibly steep learning curve, because for 25 years we did it air-cooled, and now all of a sudden we're using this new technology. It's not proven, it's not standardized. And so that to me is probably the biggest challenge in our industry, is creating a standard so that we can replicate these data centers in an efficient, standardized manner and drive the cost out.
Yeah, interesting.
Can I just add something to that, which refers to your question earlier about whether there is enough capital available for data centers. And I think for the real estate people who might be in the audience, one of the biggest challenges that real estate investors face when looking at data centers is what happens at the end of the lease. So these data centers, when we invest in it, they'll be rented by Google or AWS for 15 years. And like Doug mentioned, the technology is continuously changing. The efficiency is changing. So if I spend $1 billion on building an 85 megawatt data center, what will happen to it at the end of its life? If I buy a hotel in Park Lane, Mayfair, as a real estate investor, I know that 15 years later it would be worth more than what I bought it for. But with data centers, it's a slightly different calculation, slightly different returns. So that's where the conflict comes in terms of your core data centers.
And it's interesting you say this, because we had this debate in the early 2000s around cell towers. And people said, gee, we're really concerned about the residual value of a cell tower. And what ended up happening was we found out that the location was really important. And the interconnectivity of a mobile network is a part of an ecosystem that's daisy-chained to many other cell sites. And what we're finding with data centers, as you think about the architecture of data gravity and where data goes, these data centers are highly interconnected, not only through their fiber optic networks, but the amount of investment that happens at the core of the network that sits in these, very difficult to pick up $50 million of infrastructure and move it across the street. And so what we found is, again, we've been in the sector for over 10 years. Doug, you've been in it longer than I have. But we've already gone through our first round of renewals of these leases. And what we discovered is churn is less than 100 basis points. Across our global data center portfolio, we have 86 basis points of churn. And the other key thing that we found out is the stickiness of these locations. Rental rates have moved up on average about 22% in the renewal. Now, most of what we modeled is we thought rents would go down. We modeled 3% churn and we modeled 15% discount on rents. And what we found out is that rents were higher and the stickiness of these locations was really important.
That's absolutely, location is critical, right? And I think a lot of the new investors in data centers might not realize the importance of Ashburn, Virginia, where 70% of internet traffic passes by. So absolutely right, if you own something there, 15 years later, it will probably be more in demand. But there are a lot of data centers popping up in locations related to AI, language learning models, where one just has to be cognizant of the fact that the location might not be as critical in 15 years as Virginia might be.
Yeah, as Mark aptly pointed out, the guy with the most gray hair up here, 25 years into this, I can tell you that we have recycled our capital through our older assets, and to Mark's point, never had any issues at all. It's been very smooth. We've lost less than 100 basis points on every asset that we've ever recycled. It's been very productive, and it's about how you maintain the infrastructure over time so that you maintain the value of that infrastructure.
Goodwin?
You know, Navid, it's very interesting, right? As a real estate investor, I started investing in, at that time it wasn't even called data center. When you were doing a cell tower, we were converting these office buildings in downtown LA and downtown San Francisco into telecom exchanges.
One Wilshire.
One Wilshire, right? Those were the telecom exchanges, the predecessor of data center back then. So we always thought, what are the alternative uses of these assets when the lease runs out, or these telecom exchanges or data center get obsolete, right? But they don't get obsolete because it's almost like 3G, 4G, 5G. Every time the pipe expands, there's more content to fill it, right? In telecom terms. So in these data centers, even some of these so-called obsolete or legacy data center, there seem to be more and more actually users because of the lack of latency. So there are more and more applications that are coming up that actually need the lack of latency.
Yeah.
And that
Mark,
interconnection at a data center that he's talking about, those legacy data centers are where those fiber optic cables come together in interconnection.
Correct.
And so as we watch the building of cloud, public cloud, the last 13 years, as Doug said, what was interesting is as the cloud developed and as the cloud moved and proliferated to the edge, these locations became more important because of that connectivity. The same thing is going to happen in inference. Inference will follow the same ball flight as cloud and cloud computing. Why? 90% of AI will sit on your mobile device. Inference, by nature, is going to be near the consumer and is going to be near the device. And that makes these locations, as you start to build these language models and they proliferate into generative AI, real estate becomes more important. And real estate that's close to the connectivity, the customer, the enterprise, and IoT devices.
I just want to ask a question about the power generation. The assumption is that, I guess, most people just assume that it will be generated from renewables somehow. Is it going to be sufficient? Can renewables generate enough power based on your projections of how much demand is needed, how much supply is needed?
I'll take a swing at this because we've been spending the last 2 years working on this. I've been saying this, I think you and I talked down in Brazil about this. We don't have a generation problem. Obviously, China's done a very good job with their generation and their transmission. The challenge in Europe, as we saw on display in Portugal and Spain a couple of weeks ago, is that these grids are aging. These transmission grids were built after World War II. They never contemplated building transmission infrastructure for AI compute. I can guarantee you that was not in the design 60 years ago. And today, on a global basis, data centers are consuming about 60 gigawatts of power. So imagine New York City consumes about 5.5 gigawatts per day. So think about that. That's almost 11x New York City's happening every day in compute, going to 300 gigawatts. So we know that there's 240 gigawatts of power that has to be created to make AI work. That's a big task. And we put that up against a current market construct where essentially the data center industry is turning on about 5 to 6 gigawatts per year. And over the next 5 years, we're going to have to light up 22 gigawatts per year. So you have this massive trade and supply imbalance that's only growing, which is the demand is going from 6 gigawatts to 7 to 9 to 22 per year, and we can only turn on about 6 gigawatts per year. So to your point, the traditional path of how we build power is completely insufficient. We have to throw everything at the problem. It's solar, it's wind, it's hydro, it's, as the speaker before said, gas. Building microgrids, building grid-independent infrastructure is critical to the future of AI. And there's not a one single bullet solution. We've talked about nuclear power that's 6 to 8 years away. We have a real problem, which is how do we get the generation capabilities adjacent or near or into the data center? And this is the challenge that our industry has to deal with over the next 2 to 3 years.
Doug, do you want to weigh in on that as well, just on the sources of power?
Sure. So what's interesting is we had a little debate out in the green room about what those sources of power would be. I'm a big believer in SMRs. And I also am a realist, so I understand that we're going to have to use gas and coal and other alternative forms until we get there. But SMRs have become so proven. They've been on nuclear ships and submarines for years. They're very, very safe. And I think that we'd be naive to believe that we're going to be able to build the grids out without creating microgrids that feed data centers. So I am a big believer, and we are working down the path for integrating SMRs into our portfolio over time. I think they'll be controlled at the microgrid level by the power providers, probably not the data center providers, but we're getting ready because if you look at the other sources, they're diurnal. You don't have sun at night. Wind doesn't blow 24 hours a day. You look at what happened in Spain and Portugal and the issues that occurred there just recently. We've got to be very careful how we approach this issue because today data centers are responsible for 2% of the global power usage. It'll be 10, 12% over time. We don't know what those percentages will be, but it's going to increase dramatically. And so, again, to me, this is the biggest issue facing our industry, and we're spending a lot of time on this issue.
Yeah. Navid, I'm just going to end with you. I'm sure you get approached a lot as an allocator about these types of opportunities. How do you distinguish when you're looking at investments, who the winners are versus the other pitches that come your way?
Sure. I think we're lucky that we started investing in data centers 10 years ago, so we developed quite a few relationships early on. But when we look at a new transaction today, the key factor is location, and location in data center is all about latency and inference. So there are certain locations, whether it's Ashburn, Virginia, London, Frankfurt, Amsterdam, Texas, where it's just having the powered land bank available to build a data center makes it a transaction attractive enough to underwrite. Secondly, what the other change that has happened is we always did data centers that with good credit quality tenants like Amazon, Google, Microsoft. But now they have realized how powerful they are, that when they assign a 15-year lease to our data center, they're creating value. So it's quite important how the lease is structured, how much risk are they passing to us, and how much returns are we generating based on the risk we are taking. So it's a combination of factors, but it's essentially about credit quality of the tenant, lease, and location.
Okay. Thank you for the crisp answer. I'm sure many people will be writing down notes in this room. Panelists, thank you so much. That was really insightful. And thank you for your participation in the poll.
Thank you.